The greatest wealth transfer in modern history might just be quietly unfolding right in front of us. And while the broader market is panicking over the headlines, the most successful investor of all time is patiently waiting to strike. The global economy is currently choking on a severe macroeconomic bottleneck. With the sudden outbreak of conflict in Iran and the functional closure of the Strait of Hormuz, the arteries of global trade have been violently severed. Almost overnight, oil prices have surged past $90 per barrel. This is not just an energy crisis. It is a catalyst that is embedding deep, destructive inflationary pressures into the cost of production and transportation worldwide. Everything you buy is about to get more expensive. In a terrifying environment like this, retail investors usually panic. But if we want to survive and actually build wealth, we have to look at the ultimate masterclass in crisis capital allocation, the playbook of Warren Buffett. To understand exactly what Buffett is preparing to do right now, we have to travel back to a terrifyingly similar moment in history. Think back to the 1973 oil embargo. During that period, sudden geopolitical tensions caused a massive energy shock, quadrupling the price of oil and plunging the world into a brutal era of stagflation, which is the deadly combination of high inflation and stagnant economic growth. Buffett learned a definitive lesson during that chaotic decade that completely shaped his investing philosophy. He realized that the silent killer of wealth during high inflation is a concept known as capital expenditure. Let me explain this in a very practical way. Imagine a company that manufactures steel. It makes a decent profit, but the machines are constantly breaking down and need replacing. In a normal economy, that is a standard cost of doing business. But in an environment with rampant inflation, the cost to replace those machines might double or triple. Suddenly, all the profits the company made are completely wiped out just trying to maintain the exact same level of production. Their true economic earnings are destroyed. Buffett realized that to survive inflation, you must avoid capital-intensive businesses at all costs. Instead, you must find companies with unshakable pricing power that require almost zero physical reinvestment to grow. This brings us to the massive elephant in the room, which is the astonishing $380 billion mountain of cash sitting on Berkshire Hathaway's balance sheet. For years, critics have mocked this cash pile, calling it a massive drag on his performance during the bull market. But those critics completely misunderstand the psychological genius of Warren Buffett. Let us address the obvious paradox. Holding cash while inflation steadily eats away at its purchasing power seems insane. Most investors feel a burning anxiety to get their money out of the bank and into hard assets just to protect it from devaluation. They buy gold, they buy real estate, they buy anything they can get their hands on out of pure fear. Buffett, however, willingly accepts a temporary loss of purchasing power in exchange for the ultimate superpower in finance, absolute liquidity during a systemic crash. He does not view cash as a melting block of ice. He views cash as a perpetual call option with no expiration date. In an inflationary environment exacerbated by an energy crisis, this liquidity is not a defensive shield. It is an offensive weapon. He is not forced to panic buy structurally vulnerable companies just to stay invested. Instead, he waits for the systemic distress to completely break the market, forcing desperate sellers to offer up exceptional, bulletproof businesses at bargain prices. So, the multi-billion-dollar question is, when the market finally capitulates, what exactly is on Warren Buffett's shopping list? If he were to deploy this immense cash reserve under the current geopolitical blackout, his targets would be surgically precise. The first major pillar of his strategy would be domestic energy and infrastructure. With Middle Eastern shipping lanes effectively paralyzed by the conflict, North American energy security is no longer just a commodity. It is a matter of national survival. Buffett would aggressively target companies that capture the massive revenue upside of $90 oil, but crucially, companies whose infrastructure is already fully built. Consider a company like Occidental Petroleum. They possess long life, proven reserves, and existing pipeline distribution networks. This is the didactical key. They benefit immediately from the global supply shock, pulling in massive profits from high oil prices, without being forced to spend inflated dollars on new drilling equipment or building new refineries. The heavy lifting is already done, leaving pure cash flow to drop straight to the bottom line. The second pillar of his shopping list involves what he famously calls toll bridge businesses. These are the indispensable consumer staples, the utility monopolies, and the vital service providers that society literally cannot function without. A classic textbook example from his own portfolio is Coca-Cola. Think about the concept of supreme pricing power. If a company provides a product that consumers are fiercely loyal to and cannot easily substitute, it holds all the cards. When the price of oil skyrockets, making transportation and raw materials vastly more expensive, Coca-Cola does not absorb that loss. They simply pass those increased costs straight down the supply chain by raising the price of a can of soda. And because the brand is so dominant, you still buy it. This incredible pricing power acts as a direct, frictionless hedge against the devaluation of the currency, protecting their profit margins while their competitors are crushed by rising input costs. The final, and perhaps most powerful, pillar of his shopping list focuses on the capital-light compounders. These are the rare, elite businesses where the primary asset is not a factory or a fleet of trucks, but intellectual property, brand equity, or a locked-in software ecosystem. Apple represents the absolute pinnacle of this concept. When you understand the economics of Apple, you understand why Buffett loves it. They can scale their revenue alongside inflation without needing to build corresponding physical infrastructure. If inflation rages, Apple can simply increase the price of its hardware, its App Store fees, and its subscription services to match the environment. It costs them virtually nothing to distribute a digital software update or an extra million digital songs. They retain their monstrous cash generation capabilities even as the cost of steel, oil, and labor destroys the broader economy. Buffett's playbook is the ultimate masterclass in financial discipline and patience. Rampant inflation, closed shipping lanes, and terrifying geopolitical shocks are never reasons to panic buy hard assets just to follow the herd. Instead, they are the exact, predictable macroeconomic conditions that inevitably force the broader market to misprice the greatest businesses on earth. That $380 billion cash pile is not a mistake. It is a loaded cannon waiting for the perfect, rare fat pitch to cross the plate. And when he swings, it will be the buying opportunity of a lifetime. Subscribe for more content.